everyone. Hope you're doing well. This is the Deep Dive. My name's Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth, and I'm joined, as always, by John Creekmer, our founder and Senior Wealth Advisor. And John, we're going to get into some nitty-gritty underneath the surface of the market data today and kind of walk through where we're at. It's been a really nice run in markets since November of 2023, but we have some interesting data points that we've been tracking that are pointing to possibly where the market's heading in the months ahead. But before we hop into that, John, how are you doing today?
I'll tell you, doing great. It's interesting. I love this time of the year. I love every time of the year, actually. But this time of the year, I actually head out to my woods and start to work in the woods. So that means that if you're coming to see me anytime soon, I may not shake your hand because battling poison ivy, which is my usual Maytime thing I have to walk through. So it's a lot of fun, but it gives me time to actually sit down and spend more time in charts in the evening time and spend more time actually kind of seeing where things are at as far as overall in the marketplace. Oftentimes, Drew, I think we have a lot of people, we get focused upon top line numbers and without looking at what's happening under the surface. And right now is just kind of an interesting time of what's going on.
Yeah, it definitely is. And, John, you mentioned underneath the surface. And so we want to walk through some data. And I know you came across a really interesting study from an analyst that we work with that was talking about the current put and call option flow that we are seeing in the market. So can you walk through what a put and call option is and what that data is telling us?
Yeah, so an option is a contract that you can buy or sell. And with it, it gives you the ability to either set in the future a predetermined price that you want to buy or sell an individual stock on, a commodity on, an index on, really any underlying security. And so you can buy a put. So with a put, if you buy a put, that gives you the ability, you pay a premium for that, but that gives you the ability to sell a stock to someone at a predetermined price, regardless of what that price is in the future. And so example, if you happen to think that the stock market is going to go down, well, then you would actually buy insurance on your account and you would buy a put. And so you would say, hey, I want to buy a put of which I could sell the S&P 500 at the current price. So let's say the price right now is 5,300 as far as the S&P 500. I want to be able to sell it at 5,000, let's say 5,200, 100 points under that. Then all of a sudden, if the stock market goes down to 5,000, well, then you could actually sell it at 5,200. So if you own a put, that means that you think the stock price is going down. Now, a call, Drew, is the exact opposite. If you have a call, that means you could actually buy the stock or the index from somebody at a lower price than what it is in the future. In other words, you think I'm going to pay a premium, I'm going to buy a call, and so I own that call, which means that I have purchased the right to buy that stock at today's price or some predetermined price in the future whenever that price is higher. And so you believe the market's going up. So one of the things that I always track is the activity or the amount of calls and the amount of puts that people are buying. And it's a great leading indicator of what's really going to be happening into the future. And so whenever we see the number of puts being written in the market going up, that's a bearish indicator or an indication that institutional and savvy traders believe that the market is actually heading for a downtick. Now, we're not in as far as an extreme position. I actually have 4 zones that I look at: extreme bullish, bullish, bearish, and extreme bearish. So if it's bullish, that means we think the market's going up. Bearish means it looks like the market's going down. And extreme means it's at a very high level. So we have been we crossed over recently in the last 2 weeks into the bearish territory, the bearish zone, but we're trending very quickly up to the extreme bearish zone. As a reminder for everybody, the last time that we were at the extreme bearish zone, we actually were there in about April of 2023, and then it crossed down into the bullish zone. But early in 2022, we were in an extreme bearish zone. We all know what happened in 2022. So, Drew, it's one of those leading indicators a lot of folks don't look at as far as market movement, but more institutions, insurance companies, and family offices and hedge funds are actually buying puts right now. And that's an indicator that they believe the market's heading lower, or at the very least due for a high level of volatility.
And it's interesting, John, to compare what institutional investors, which you just spoke about, are doing with puts right now to protect themselves, but then also to compare it to what retail investors, so everyday folks like you and me, what we're seeing retail investors do right now. Currently, retail investors have the highest level of activity going back to January of 2022. And historically, when you see retail investors having a high level of trading activity, that typically comes right around high points in the market. And so we have that data point plus your data point on institutional investors that's pointing to there might be some volatility in markets in the months ahead. And so, John, I think the big question is, well, with this data, what do we do about it? How do we react, and how do we ensure that we stay on track to achieving our goals?
We believe you should always place trades based upon data, not based upon emotions, but what are the markets telling us? So be a market whisperer and look at that. And so whenever you're looking at that, what we have done outside our portfolios, we actually have 6 different cycles or ranges that any of the markets we can be in. So we look at the S&P 500, the Dow Jones, the NASDAQ, the New York, and the Russell 2000, the small cap index. And every one of those can be at a different spot or a different area at any time. But we look to see, are we seeing commonalities across the board in all 5 indexes? And so we could be in what's called a bullish power, which means the market is moving higher and momentum is actually accelerating to the upside. Or we could be in bullish overweight and bullish neutral, or we could be in bearish neutral. That means the markets are kind of going a little bit sideways, but starting momentum has really slowed down, or maybe momentum is starting to accelerate to the downside. We could be at bearish, or we could be in bearish power. And right now, Drew, I believe we're sitting at bearish neutral right now, which that indicates that we're starting to see internal fundamentals starting to fall apart a little bit and momentum starting to slow down as far as underneath the market. Now, Drew, we have various rules. We'll explain to everybody, if you would, whenever we get to bearish neutral, what are those steps that are prudent to take? And again, we're not trying to time the ultimate high in the market or the ultimate low in the market. You're simply wanting to make some changes inside your portfolio, your allocations, to protect you a little bit on the downside so you can miss out on the full brunt of a large pullback.
Yeah. So when we see our indicators move from, say, bullish power down to just bullish or bullish neutral, or bearish to bearish neutral, that's a sign that we need to start being prudent and taking some gains off the table and reducing risk inside of accounts. And so, John, actually back here in March and April, we saw those indicators beginning to switch. And so we already raised a little bit of cash to protect some of those awesome gains we've seen since November of last year. So right now, with how we have clients' accounts allocated, still have our toes in the market for sure, but we're not fully invested. We want to make sure to take some of those gains we've received the last 6 months off the table and protect them. And really, we're going to wait for the market to pull back from this point to a more appropriate buying level, or a switch from being bearish neutral to maybe being bullish. And so where we're at today, we're lower risk, and we're going to wait to see how the indicators and how the markets play out before we make a step one way or another. And so, John, I think the big question is, where do you feel we are going, and what are your thoughts from as a head of our investment committee with how the rest of this year is going to play out?
Federal Reserve just came out the day we're actually recording this, and their meeting notes from the May 1st meeting were released, and there was a lot of high-level concern about inflation. They're being unable to control inflation and get it back down to their target range, which is a little bit over 2%. And so the discussion was, we're probably not going to be decreasing interest rates anytime soon. We're going to maintain our current level. There was a little bit of chatter about potentially increasing rates in the future. So it's interesting how we actually went from a lot of people in the market last fall anticipating a 6-time decrease in 2023 or 2024. And actually what we're seeing is we're probably not going to see any decreases at all this year. If we do, it might be one toward the fourth quarter, but that is probably all we're going to see is where data is going. And so with interest rates there, that means everything is going to rise and fall solely based upon current earnings reports. And so we have a number of tech companies that are putting out earnings here over the next couple of weeks. You want to watch those closely and make a decision on what you should invest in. So right now, you want to be looking towards safety assets. You want to be positioning toward companies that have strong dividends, that have strong cash flows and strong profitability, and very low debt, quite honestly. And so on portfolios, that's where we see things going because we do think instability is going to be here throughout the entire part of this summer.
Yep, absolutely. I think that's well said. Those are the changes that we've already made inside of all of our clients' portfolios, John. We've definitely been overweighting to those dividend stocks and taking some gains out of those technology stocks that we are starting to see earnings slow down on. So we feel folks are really well positioned for whatever may come down the road in the months ahead. So, John, I think we've covered a lot of ground here. What's your one last thought for today?
Make sure you always align your risk in your portfolios with your goal objectives. And keep in mind, folks, the goal objective is really a time frame of when you're going to need the money and the dollar amount that you're going to need. Once you define that, you're able to say, let's set the proper level of risk to make sure we achieve our goals in that time frame. And so that ultimately is goal-based investment management. As you get closer to needing those dollars, you're going to want to decrease the level of risk. Now, you just don't want to all of a sudden randomly decrease it. You want to do it based upon where you're at in the market cycle. So right now, make sure you understand your goals, make sure you understand your timelines, and you understand the dollar amounts you're going to need. And then from there, talk with your advisor about making sure that your risk is properly aligned with those goal objectives.
Yep. Well said, John. Well said. And guys, if you have any question about anything that we covered today, don't hesitate to reach out to your advisor. Our team's fully up to date on where we stand with markets and how we're adjusting portfolios. So if you have any questions, reach out and our team is standing by to help in any way that we can. So thanks for the time, guys, and we'll talk to you soon.